In a funny way, I think from here on in, everyone does. I mean, it is where the battleground is. Where are interest rates going to settle? You know, we've still got an inverted yield curve. We've obviously moved from pricing in I thought, a bonkers number of cuts to a much more rational kind of level of sort of saying, actually, we're at a fairish rate right now to balance off the inflation and growth outlooks. And it is quite a determining factor, as we talked about a moment ago, for the major leadership of the market, which is the big tech. It's you know, most people would admit it's quite expensive or very expensive, but that can be supported if rates stay a bit lower, and so that's kind of helpful for the market. So I think it is huge. I mean, I think the news on quantitative tightening, it won't probably surprise anyone. I think they're getting to a level where they're going to slow that process down, and bank reserves as a percentage of the balance sheet are sort of at the levels we've seen towards the lows historically. So that's, I think, reasonably well forecast. I can't see, stepping back further, I think this level of interest rates is perfectly fine. An economy should be able to deal with 4 to 5% interest rates. I think it's for the birds to think that in a world where inflation is bottoming and in some cases turning up and there's early signs of life, partially due to the strong economy with massive government stimulus behind it, that they're going to be cutting in any meaningful way. So that from the way we've thought about it for the last 15 years, and I think for longer too, there's no economic rationale for cutting. The reason they might cut is because the US government can't afford it. And that's a much scarier reason to have to cut.
I take your point about being hawkish because the inflation rate is not coming back and it may not just be a bump in the road. But what about the casualties? And we're hearing it through the lens of the consumer now. McDonald's, the latest to talk about the change in consumer patterns, trading down, changes of consumer behaviour, which we anticipate anyway at this point in the cycle. But when does it catch up with central bankers and they're concerned about fragilities and breaking something in the economy?
Well, I think it has to sort of break something in the economy. You know,
I guess a no soft landing then.
That's it, sort of. I mean, I think, well, we're clearly in a soft landing at the moment, but it's a very stimulated one. I mean, I think we'd be in a recession if the government hadn't done their extraordinary spending bills, and you can sort of calculate that. It's probably the problem with massive government stimulus and the problem with massive monetary stimulus is it accentuates the haves and have-nots. It always drives that wider. The 1% get more, and the lower income consumers always get less well off. So, yeah, a number of companies we've been talking to for the last 6 months have pointed that discrepancy out. And the lower income consumers are really struggling. But they do have a job, and the mandate is full employment. And so it's reaching beyond the mandate on the employment and economic side to start saying, well, we need to do more to anticipate a weakness, in my opinion. And on the inflation side, it's lower, but it's not too, you know, and it's ticking up. And so it just feels like they are longing to cut rates a little bit. They slightly know that the Treasury needs them to. And that, I think, is where the battleground may move a little bit, because I expect a hawkish-ish Fed.
You just said something fascinating at the end of your last one. Many fascinating things, Freddie, of course. And I've just actually already flagged it to .com, so I want you to flesh it out for me. The reason the Fed may cut, ultimately, is because the government can't afford current rates, or words to that effect. And that is much more scary. Just flesh that out for us.
Well, I mean, you've probably seen the charts of the exponential growth in interest payable, which is now...
I've seen the Congressional Budget Office data, and it doesn't make for pretty reading, no matter who's in the administration.
Exactly, it doesn't, because the facts are there now. You've borrowed the money, you're running a fiscal deficit of 5-6%. You know, you can't... You know, either you withdraw all the stimulus programs, and that still takes a wind-down period, which is going to be a real challenge, especially somewhere like America where they're sort of legislated, or you have to borrow that money. And so, you know, we don't yet... 12 years ago, remember all the European banking crises, you had bond vigilantes, you had scaled leverage macro traders with enough firepower to come out and push the market. Macro funds died then after, and really the capital invested in that kind of strategy was weak. But it's been coming back over the last 3 years. So there is an argument that within the financial system there is a lot of pressure. At the moment, to Karen's point, it's on both sides, but it is there. The bigger one is if China starts saying, actually, we don't want anymore. Or Japan says, actually, we want to buy more gold. We don't want to buy more treasuries.
So let me add this all together, because I think this is worth just one more go at it. The US debt load is becoming so much that it could be potentially untenable, or certainly unattractive, to own for a large amount of the key international investors. And as such, that might bring back the vigilantes. And as such, we might have to learn to live with much higher yields? Is that the kind of the chronology?
Yes, and the solution would either be to live with much higher yields or much lower government spending, because that would reduce issuance, which would solve the problem a different way.
But would that then have the benefit of the dollar coming off aggressively and readdress some of those imbalances in trade and deficits being run by the US?
I think so. The selling of US Treasuries is in part a sell of US dollars.
Yeah.
But if it's causing interest rates to move higher and the interest rate differentials around the world continue to widen,
It could be chaotic.
I think the dollar would stay strong. And it could be chaotic. It's a little bit conspiracy theory-esque because, the level of debt has never mattered. Debt to GDP has gone up every year since the war. And so, it's gone up like a straight line, and the markets have bull and bear markets. So the level is not the point. It's kind of the changes in it and the construction of it. And I think it's just the growth in those interest payments are really quite staggering.